In the stock market, there are always fluctuations. If the market always went up, everyone would be rich, or if it always went down, nobody would invest. Understanding that these fluctuations are normal is important. Warren Buffett is known for his long-term investments.
About the fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. I mean, we're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. When stocks are down, we're going to be buying on balance. And who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers. And that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. And they have that feeling that they just feel better when stocks are going up.
He has held shares of Coca-Cola for 34 years, American Express for 29 years, and Moody's Corporation for 22 years. He sees the market downturns resulting from economic events not as crises but as opportunities.
If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Selling a stock as it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, "I'll pay you 15," you don't sell it because the quote's 15. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business.
These are the times that people like Warren Buffett refer to as crises, and when companies become more affordable, it's a great opportunity to add more shares to your portfolio at a lower cost. For investors who practice long-term investment, such short-term market fluctuations hold little significance. To protect the value of your portfolio during crises, you may prefer to invest in companies that regularly pay dividends. Companies that pay dividends regularly are less affected by short-term crises compared to others. Additionally, in essential sectors like health and food, the probability of significant and sudden drops is lower. No one stops shopping just because there's a war or a virus outbreak. I hope you've enjoyed the video, and you can subscribe to our channel for more investment-related videos.